There is a ghost in the machine of modern finance. It is an unseen force, a relentless pressure that whispers in the ear of every investor, from the novice with $1,000 to the hedge fund titan managing billions. It's the voice of our culture, the hum of the 24-hour news cycle, the flicker of the stock ticker in the corner of our eye. And the message it delivers is always the same: do something. The market is moving. Your neighbor is getting rich. A recession is coming. A boom is here. React, trade, act, now. This pressure, this compulsive need for action, is the single most destructive force in the pursuit of wealth. It is the siren song that has lured countless portfolios onto the rocks of ruin. But what if the greatest secret to building lasting generational wealth wasn't a secret algorithm or a hot stock tip? What if the most powerful weapon in your entire financial arsenal was the discipline, the sheer audacity to do absolutely nothing? This is the central paradox of the man who stands as the greatest investor in human history. Warren Buffett, the Oracle of Omaha, a figure synonymous with unimaginable wealth, has built his empire not on a foundation of frantic activity, but on a bedrock of what he calls almost sloth-like inactivity. He has taught the world that in the chaotic arena of the stock market, your ability to sit still, to be patient, to be, for all intents and purposes, lazy, is not a weakness. It is your ultimate strategic advantage. It is a superpower. This is not an argument for passive ignorance. It is a deep dive into the philosophy of active, disciplined patience. It is the understanding that the greatest financial returns come not from the handful of brilliant moves you make, but from the thousands of catastrophic, impulsive, emotionally driven mistakes you have the wisdom and the fortitude to avoid. Today, we deconstruct this philosophy. We will dismantle the cultural and psychological machinery that pushes you toward costly action, and we will rebuild your entire approach to investing from the ground up. You will learn to see the market not as a casino demanding constant bets, but as a patient hunter's landscape where you wait, calmly and quietly, for the rare, perfect, unmissable opportunity to appear. You will learn to equate motion with risk and patience with immense, compounding power. You will stop being a frantic trader and begin the transformation into a calm, collected, and vastly wealthier business owner. We begin this journey by exploring the foundational pillar of this entire philosophy, the radical reframing of inactivity. We must learn to see it not as a void, not as a lack of strategy, but as a strategy in and of itself. We must build what can only be described as a fortress of inactivity, a mental stronghold where patience is redefined not as waiting, but as guarding. Guarding your capital, guarding your emotional energy, and guarding your focus for the few moments that truly matter. To understand this, we must travel back to the year 1972, a time when Warren Buffett and his partner Charlie Munger were about to make a decision that would forever alter the DNA of their burgeoning empire, Berkshire Hathaway. The company in question was a small, family-owned chocolate maker based in California, See's Candies. On the surface, it was everything Buffett had been trained to avoid. His mentor, Benjamin Graham, the father of value investing, had taught him to be a cigar-butt investor, to look for discarded companies trading for less than their liquidation value, take one last free puff, and then sell. See's was no cigar butt. The family wanted $30 million for the business. At the time, See's had about $8 million in tangible assets and was earning about $2 million a year after tax. The price was more than 3 times its book value. For the Buffett of the 1960s, this was heresy. It violated the core tenets of his training. His instinct, the ingrained habit of a decade of success, screamed at him to walk away. This is the first crucial moment. The pressure to act, in this case, the action of rejecting the deal based on old rules, was immense. But a new voice was emerging, that of his partner, Charlie Munger. Munger argued that it was better to buy a wonderful business at a fair price than a fair business at a wonderful price. He saw that See's wasn't just a collection of assets, it was a brand that lived in the minds of its customers. It had pricing power. People would happily pay a premium for its chocolates year after year. It possessed a deep, enduring competitive moat. After intense negotiation, they agreed on a price of $25 million. They took the plunge. But the purchase is not the most important part of this story. The most important part is what happened for the next 50 years. Almost nothing. They did not fire the management. They did not radically re-engineer the production lines. They did not try to reinvent the brand. They identified a wonderful business, and their primary strategy was to get out of its way. They practiced active inactivity. Year after year, See's Candies became a cash geyser. The initial $2 million in earnings grew and grew. By the early 2000s, See's had generated over $1 billion in pre-tax earnings for Berkshire Hathaway, all from that initial $25 million investment. By today, that number has surpassed $2 billion. That single purchase, followed by decades of disciplined inaction, provided the capital for countless other Berkshire investments. It was the engine that funded their purchases of insurance companies, railroads, and utilities. The genius was not in some complex financial engineering applied to See's. The genius was in the patience to let a great business compound, uninterrupted. They bought it and then they sat on their hands. For 50 years. This story is the foundational anecdote for the entire Buffett philosophy. It demonstrates that the most powerful action an investor can sometimes take is to consciously and deliberately do nothing at all, allowing a high-quality asset the time it needs to work its magic. It's the shift from thinking like a stock picker to thinking like a business owner. Once you own a great business, your job isn't to constantly tinker. It's to protect its long-term advantages, and for the most part, that means letting it run. The See's Candies acquisition was a masterstroke, not just of capital allocation, but of behavioral discipline. The decision to hold See's Candies for half a century, to resist the urge to sell after it doubled or tripled in value, is a triumph over one of the most deeply ingrained human psychological tendencies, the preference for immediate rewards. The underlying psychological principle at play here is our struggle with delayed gratification. This concept was most famously illustrated in the 1960s and 70s by psychologist Walter Mischel in what is now known as the Stanford Marshmallow Experiment. In this study, a child was placed in a room with a single marshmallow on a plate. The researcher told the child they could eat the marshmallow immediately, but if they could wait for 15 minutes until the researcher returned, they would be rewarded with a second marshmallow. It was a simple test of willpower. Some children ate the marshmallow the moment the door closed. Others agonized, fidgeted, and eventually gave in. But a small fraction managed to wait the full 15 minutes and claim their double reward. The truly fascinating part of the study came years later, in the follow-up research. The children who were able to delay gratification and wait for the second marshmallow went on to have higher SAT scores, better educational attainment, and healthier body mass indexes as adults. They were, by many objective measures, more successful in life. Their ability to subordinate an immediate impulse to a long-term goal was a powerful predictor of future success. Investing is the marshmallow test for adults, played out over decades with stakes in the millions of dollars. The market constantly places a marshmallow in front of you. It's the dopamine hit of logging into your brokerage account and seeing a stock up 20%. The marshmallow is the temptation to sell and lock in that gain. Eating that marshmallow feels good. It provides immediate certainty and a rush of satisfaction. The second marshmallow, the one that is far larger but far off in the future, is the result of letting that 20% gain grow into a 200% gain, and then a 2,000% gain over 20 or 30 years. Warren Buffett's entire career is a testament to his mastery of this psychological challenge. He is the ultimate two-marshmallow investor. This ability is governed by the prefrontal cortex, the part of our brain responsible for executive decision-making, planning, and impulse control. The financial world, with its constant stream of breaking news, price alerts, and expert predictions, is designed to bypass this rational, slow-thinking part of our brain and appeal directly to our amygdala, the ancient, emotional core that governs fear and greed, our fight-or-flight response. Every market dip is a perceived threat, urging you to flee, sell, Every hot trend is a perceived opportunity, urging you to pounce, buy. Resisting this requires immense mental energy. It requires consciously rewiring your brain's reward system. You must train yourself to derive satisfaction not from the thrill of the trade, but from the quiet confidence of owning a wonderful asset. The goal of this mental shift is to transform your thinking. Instead of feeling anxiety when you are not trading, you should feel a sense of power. The default state is not action. The default state is a well-guarded fortress of cash and high-quality holdings. Action is the rare exception, undertaken only when the odds are overwhelmingly in your favor. This is the core of a true wealth mindset. It's the understanding that wealth is not built by a flurry of activity, but by a series of deliberate, well-considered decisions, followed by very, very long periods of doing absolutely nothing. It is, in essence, winning the marshmallow test over and over again for an entire lifetime. Translating this profound psychological principle into a practical, repeatable process is the key to moving from theory to tangible results. The blueprint for achieving this is what we can call the sit-on-your-hands protocol. It is a series of concrete steps you can take to build your own fortress of inactivity and protect yourself from your worst impulsive instincts. The first step is to rigorously define and write down your circle of competence. This is a concept Buffett and Munger speak about constantly. You must, with brutal honesty, identify the industries, businesses, and technologies that you truly understand. Not what you've heard about on the news, not what your friend recommended, but what you could explain to a 10-year-old with clarity and confidence. This circle might be small. That's not just okay, it's a strength. Your written circle of competence becomes your first line of defense. When an investment idea appears, a hot biotech stock, a new cryptocurrency, your first question is simple: is this inside my circle? If the answer is no, the default decision is not to do more research. The default decision is to do nothing. You immediately discard it. This single habit will eliminate 99% of the investment temptations that derail the average person. The second step is to create a personal investment policy statement. This is a formal document, a constitution for your financial life. It should be no more than 2 pages long, and it must outline your long-term financial goals, your time horizon, your tolerance for risk, and, most importantly, the specific, non-negotiable criteria a business must meet before you will even consider investing in it. Will you only buy companies with less than a certain amount of debt, with a return on equity above 15%, with a consistent history of rising dividends? Write these rules down when you are calm and rational. This document then becomes your anchor in a storm. When the market is crashing and you feel the panic rising, you don't have to think. You simply refer to your constitution. It pre-commits you to a long-term strategy, making it much harder for your emotional, short-term brain to hijack your decision-making. The third, and perhaps most powerful step, is to implement a decision journal. Before you ever execute a buy or sell order, you must open a simple notebook or a document and write down the date, the name of the company, and the action you intend to take. Then, you must articulate your thesis in clear language. Why are you buying this? What is your rational expectation for its future? What are the key metrics that support your decision? Crucially, you must then force yourself to write down the opposite case. What are the biggest risks? What could go wrong? What is the strongest argument for not doing this? This simple act of writing forces you to slow down. It moves the decision from the fast, emotional part of your brain to the slow, analytical part. It creates a record that you can review in the future to learn from your successes and, more importantly, your mistakes. Over time, this journal becomes an invaluable coach, revealing the biases and patterns in your own thinking. Finally, the fourth step is to introduce deliberate friction into your process. In a world of zero-commission trades and one-click phone apps, friction is your friend. Schedule your portfolio check-ins. Decide that you will only review your holdings on the first Saturday of each month. This prevents the daily gyrations of the market from influencing your mood and decisions. Go into your phone's settings and remove the stock ticker app from your home screen. Unsubscribe from the breaking financial news alerts. Each piece of friction you add is another layer on the wall of your fortress, another barrier that protects your long-term plan from short-term emotional whims. Together, these 4 steps, defining your circle, writing your policy, journaling your decisions, and creating friction, form a practical blueprint for patient investing. They are the tools you need to turn the abstract idea of doing nothing into a concrete, disciplined, and highly effective investment strategy. To truly appreciate the power of this disciplined inactivity, we must examine its opposite. We must venture into the wilderness where 99% of market participants live, a place ruled by frantic motion, constant noise, and the deeply flawed belief that activity equals progress. This is the path of the busy investor, and it is a path littered with financial disappointment. Consider the archetype of the modern, actively managed mutual fund. The portfolio manager is a highly intelligent, well-educated individual. Their clients are paying them a fee, typically 1 to 2% of assets per year, to actively manage their money. This fee structure creates a powerful and perverse incentive. The manager feels a deep-seated need to justify their existence. If a client looks at their portfolio statement and sees no trades for 6 months, they might start to wonder, what am I paying this person for? This pressure, whether real or perceived, leads to what is known as action bias. The manager feels compelled to act, to trade, to buy the latest hot stock, to sell a position that has recently gone down, simply to demonstrate that they are earning their keep. They are confusing motion with progress. This often results in a portfolio that is constantly churned. A company that was a strong buy in January becomes a sell in June. They chase trends, trying to time sector rotations, moving from tech to energy to healthcare based on the latest macroeconomic forecast. This constant activity, this diversification, as Peter Lynch called it, has disastrous financial consequences. First, it incurs massive transaction costs. Every buy and sell order chips away at the principal. Second, it is incredibly tax inefficient. Selling a winning position after holding it for less than a year triggers short-term capital gains taxes, which are taxed at the much higher ordinary income rate, effectively making the government your largest and most reliable partner. Third, and most importantly, it guarantees that the manager will never fully benefit from the magic of long-term compounding. They are constantly cutting their flowers and watering their weeds, selling their big winners too early to lock in a small gain, and holding on to their losers in the hope of breaking even. They are trapped in a cycle of activity that looks impressive and sophisticated, but which study after study has shown consistently underperforms a simple, low-cost index fund over the long run. The individual investor, bombarded by financial media, is pushed down this same destructive path. They are told they need to be in the know to have an opinion on interest rates, inflation, and geopolitical events. They watch a TV pundit scream about a paradigm shift and feel a jolt of anxiety. Am I positioned correctly for this? They wonder. They log into their account and start tinkering, selling a little of this, buying a little of that. They are not investing, they are reacting. They are a leaf in the wind of market sentiment, and their portfolio reflects this chaos. This is the antithesis of the Buffett approach. Buffett's inactivity is born of supreme confidence in the businesses he owns. The path of the 99% is born of a deep-seated insecurity, a fear of being left behind, a need for constant validation that can only be soothed by the click of a mouse executing a trade. It is the fundamental misunderstanding of the game being played. They think they are in a speedboat race, requiring constant steering and throttle adjustments. The intelligent investor understands they are the captain of a massive aircraft carrier. The goal is to set the right course and then let the powerful engines of compounding do their work with minimal, carefully considered adjustments over a very long journey. The financial consequences of choosing the path of patient inactivity over frantic motion are not small or incremental. They are monumental, creating a chasm of wealth between the two approaches over time. The direct financial connection can be seen most clearly through the devastating impact of two silent portfolio killers: fees and taxes. Let us construct a simple but powerful scenario. Imagine two investors, patient Penelope and active Adam. Both start with a $10,000 investment on their 30th birthday. Both are fortunate enough to achieve the same gross annual return of 10% before fees and taxes. The only difference is their strategy. Penelope chooses a simple, low-cost S&P 500 index fund. She buys it once and practices a buy-and-hold strategy, doing nothing for 35 years. Her annual fee is a minuscule 0.04%. Because she never sells, she defers all capital gains taxes until her retirement at age 65. Adam, on the other hand, believes he can beat the market. He hires an active manager who charges a seemingly reasonable 1.5% annual fee. This manager, in an attempt to justify this fee, churns the portfolio, with an average holding period of 1 year for each stock. This means Adam's gains are taxed annually at the short-term capital gains rate, which we'll assume is 32%. For the first few years, the difference seems negligible. After 1 year, Penelope has $11,000, less a $4 fee. Adam has $11,000, but his $1,000 gain is reduced by a $150 management fee and then a $272 tax bill, leaving him with $10,578. He's already $400 behind. But now, the unseen force of compounding takes over. Penelope's larger capital base starts growing on itself. Adam's smaller, tax and fee-eroded principal has less to work with each year. The gap widens, slowly at first, then exponentially. By age 40, Penelope has over $27,000. Adam has just over $20,000. By age 50, Penelope has crossed $72,000. Adam is struggling to reach $48,000. Now for the final staggering result. At age 65, after 35 years of disciplined inactivity, patient Penelope's single $10,000 investment has grown to over $280,000. She sells and pays a long-term capital gains tax of 15%, leaving her with a final, spendable nest egg of over $238,000. Active Adam, whose portfolio generated the exact same gross return, is left with a shockingly small $75,000. His wealth has been systematically siphoned off, year after year, by the twin termites of high fees and high taxes, both direct results of his strategy of constant activity. He has lost over $160,000, more than 16 times his initial investment, simply by refusing to sit still. This is not a theoretical exercise, it is the mathematical reality for millions of investors. Inactivity directly translates to a massive financial advantage by allowing the power of compounding to work uninterrupted and by minimizing the wealth-destroying friction of costs and taxes. It proves that what you don't do, the fees you don't pay, the taxes you don't trigger, and the impulsive mistakes you don't make are often far more important to your final outcome than the brilliant moves you think you are making. The fortress of inactivity is not just a philosophical concept, it is a quantifiable, multi-$100,000 strategic decision. The human mind is a flawed instrument for long-term financial decision-making. It is a machine built for survival on the savannah, not for navigating the abstract complexities of the stock market. It is plagued by cognitive biases, subconscious shortcuts in thinking that, while useful in our evolutionary past, are catastrophic when applied to portfolio management. The greatest of these, the siren song that leads more investors to ruin than any other, is the action bias. To truly master the art of patient investing, we must first dissect this psychological enemy, understand its origins, and recognize its insidious whispers in our own minds. The foundational anecdote for this struggle against internal pressure is perhaps the most trying period of Warren Buffett's entire career, the dot-com bubble of the late 1990s. From 1995 to early 2000, the world seemed to go mad. The advent of the internet had unleashed a speculative frenzy unlike any seen before. Companies with no revenue, no profits, and often no viable business plan were going public and achieving market capitalizations in the billions of dollars overnight. Pets.com. Webvan. GeoCities. These were the darlings of a new economy, where old metrics like earnings and book value were considered quaint relics. Meanwhile, Warren Buffett and Berkshire Hathaway were being openly ridiculed. They were dinosaurs, fossils from a bygone era, who just didn't get it. In 1999, the prestigious financial magazine Barron's ran a cover story with the headline, "What's Wrong, Warren?" The article detailed his, quote, underperformance, questioning if the world's greatest investor had lost his touch. The social pressure, the professional mockery, the sheer psychic weight of watching teenage tech founders become paper billionaires while his own value-oriented stocks languished was immense. The action bias was screaming at him from every corner of the culture. Do something. Buy something. Anything with a .com at the end of its name. Every fiber of his being was being tested. This was not a period of quiet, peaceful inactivity for Buffett. It was a period of intense, active, and painful restraint. He famously said at the time that he would rather be criticized for being out of step with a boom than for being in step with a bust. He and Munger stuck to their core principle. They would not invest in businesses they could not understand and could not value. And they could not, for the life of them, project the cash flows of these new tech companies 10 or 20 years into the future. So they did the hardest thing an investor can ever do in the midst of a raging bull market. Absolutely nothing. They sat, patiently, holding billions in cash, weathering the storm of criticism. Then, in March of 2000, the bubble burst. The Nasdaq index, which had soared above 5,000, began a brutal, gut-wrenching collapse. Over the next 2 years, it would fall nearly 80%. The high-flying tech darlings of yesterday went bankrupt. Trillions of dollars of speculative wealth vanished into thin air. And Warren Buffett the dinosaur was revealed to be the ark. His discipline had not just preserved his investors' capital, it had positioned him to take advantage of the carnage that followed. His decision to do nothing was the most powerful and ultimately most profitable decision he could have possibly made. It was the ultimate triumph over the siren song of action. The action bias that Buffett so masterfully resisted during the tech bubble is not a character flaw, it is a deeply rooted feature of human psychology. Its origins can be traced back to our evolutionary past. Imagine an early human ancestor hearing a rustle in the tall grass. They have two choices. They can do nothing, assuming it's just the wind, or they can act, perhaps by throwing a spear or running away. If they do nothing, and it's a lion, they are eaten. Game over. If they act, and it's just the wind, they suffer a minor embarrassment and a small expenditure of energy. The evolutionary calculus overwhelmingly favored action. In an environment of immediate physical threats, the cost of inaction was potentially infinite, while the cost of unnecessary action was minimal. Our brains are therefore hardwired with a bias toward doing something in the face of uncertainty. This ancient software is still running in our modern skulls as we navigate the financial markets. The rustle in the grass is now a headline from the Federal Reserve, a volatile day of trading, or a negative earnings report. Our instinct screams at us to act, sell the declining stock, chase the soaring one. The problem is that in investing, the calculus is reversed. The cost of unnecessary action, selling in a panic, buying into a bubble, is immense, while the cost of prudent inaction is often zero or even positive. Compounding this primary bias are several other psychological traps. First is the pernicious influence of herd bias, more commonly known as FOMO, or the fear of missing out. This is the powerful social instinct to do what everyone else is doing. When we see our neighbors and colleagues seemingly getting rich quick on a hot stock, it triggers a deep-seated anxiety and a powerful urge to join the herd, regardless of our own independent analysis. This was the dominant force during the dot-com bubble. People weren't buying tech stocks based on a rational assessment of their value. They were buying them because everyone else was, and they couldn't bear the thought of being left behind. The third major culprit is overconfidence bias. After a few successful trades, our brains can trick us into believing we have a special skill or insight that allows us to outsmart the market. We mistake luck for talent. This leads to more frequent trading, taking on more risk, and straying outside our circle of competence. We start to believe we can predict the unpredictable, a belief that the market eventually and often brutally humbles. Together, action bias, herd bias, and overconfidence bias form a toxic psychological cocktail that drives the average investor towards self-destructive behavior. They create a constant internal pressure to be busy, to tinker, to react. Overcoming them requires more than just knowing they exist. It requires building a conscious system of behavioral finance checks and balances to counteract this flawed evolutionary wiring. It requires understanding that in the world of stock market psychology, the person who can best control their own emotions, not the person with the highest IQ, is the one who ultimately wins. To combat these deeply ingrained psychological traps, we need an equally powerful set of practical tools, a mental framework designed to short-circuit our worst impulses. This is the Antidote to Action framework, a series of exercises that force a wedge of rationality between an emotional stimulus and a potentially destructive financial reaction. The first and most radical tool in this kit is the practice of a news media fast. For 1 full week, commit to a total blackout of financial media. No cable news channels with their screaming hosts, no clicking on market news websites with their breathless headlines, no scrolling through financial social media feeds. The only financial data you are allowed to check is the total value of your portfolio, and only once, at the end of the 7-day period. This exercise is profoundly illuminating. It breaks the stimulus-response loop that governs most investors' behavior. You will notice the world does not end. Your portfolio does not evaporate. What does evaporate is the constant, low-grade anxiety and the feeling that you must react to every piece of information. You begin to differentiate the signal, the long-term performance of the businesses you own, from the deafening noise of daily market commentary. This fast recalibrates your mind, proving that you can be a successful investor without being a constant consumer of financial infotainment. The second tool is the 3 whys rule. Before you ever act on a sudden impulse to buy or sell a security that is not part of your pre-scheduled plan, you must subject the impulse to this simple interrogation. Ask yourself why 3 times, drilling deeper with each question. For example, I feel an urgent need to sell my shares of XYZ Corp. First why? Because the stock price is down 15% this week. Second why? Because they announced a disappointing earnings report. Third why? Because their shipping costs increased unexpectedly due to rising fuel prices. By the third why, you have moved past the emotional reaction to the price drop and are forced to confront the fundamental business issue. You can then ask a much more intelligent question. Is this temporary increase in fuel costs a long-term threat to the company's competitive advantage, or is it a short-term problem that the market is overreacting to? This process forces analytical depth over shallow panic. The third tool is the appointment of a devil's advocate. Human beings are masters of confirmation bias. We naturally seek out information that confirms our existing beliefs. To counteract this, you must institutionalize dissent in your decision-making process. Before making a significant investment, your task is to actively seek out and articulate the strongest possible case against doing it. This can be a role you assign to a trusted and skeptical friend, or it can be a written exercise you perform yourself. You must argue, with passion and evidence, why this investment is a terrible idea, destined for failure. This process inoculates you against falling in love with a story stock and forces you to see the risks and potential downsides with clear eyes. It is the intellectual equivalent of stress testing a bridge before allowing traffic to cross it. These 3 practices, the news fast, the 3 whys, and the devil's advocate, are not just clever tricks. They are cognitive circuit breakers. They are designed to engage your prefrontal cortex, the slow, rational part of your brain, and to disarm the amygdala, the fast, emotional part that is so susceptible to the siren song of action. They are the practical application of behavioral finance, a system for protecting your portfolio from its greatest single threat: you. The disastrous consequences of succumbing to the action bias are not hypothetical. We have a perfect recent case study in the behavior of the Robinhood trader archetype that emerged during the meme stock craze of 2020 and 2021. This phenomenon provides a stark and cautionary tale of what happens when a frictionless trading platform combines with powerful psychological biases like herd mentality and FOMO. Millions of new investors, many stuck at home during the pandemic, opened brokerage accounts and were drawn into what felt like a revolutionary movement. Driven by social media platforms like Reddit's Wall Street Bets, they piled into a handful of heavily shorted stocks, most notably GameStop and AMC Entertainment. The initial narrative was compelling: a band of retail Davids taking on the Wall Street Goliaths. The early gains were astronomical and intoxicating. For a moment it seemed a new paradigm had arrived. However, this was not investing. It was a mass psychological event. People were not buying shares of GameStop because they had analyzed its declining brick-and-mortar video game retail business and concluded it was undervalued. They were buying because the price was going up, because there was a thrilling story, and because they were terrified of missing out on the ride. This was herd bias, supercharged by social media algorithms. The app's interface, with its confetti animations for making a trade, gamified the experience, turning sober financial decision-making into something akin to a mobile game or a slot machine. This tapped directly into the brain's reward centers, encouraging more and more activity. This is the path of the 99% on steroids. It was pure, unadulterated action bias. The consequences were predictable and tragic for many. The latecomers to the party, those who bought in at the peak of the frenzy driven by an unbearable fear of missing out, suffered catastrophic losses, as the stock prices inevitably returned to levels more aligned with their underlying business fundamentals. People who had invested their life savings, or even borrowed money to participate, were wiped out in a matter of days. They confused speculation with investment. They confused a temporary price spike with a sustainable increase in value. They were driven entirely by emotion, by the thrill of action, and by the social proof of the crowd. This stands in stark contrast to the intelligent investor's approach. The intelligent investor would have looked at GameStop's financials, recognized its deteriorating business model in an increasingly digital world, and concluded that its intrinsic value was far, far below the speculative price. They would have felt no FOMO, only a calm detachment, recognizing the event for what it was: a temporary mania, a fascinating sociological phenomenon, but certainly not a sound basis for deploying long-term capital. The meme stock saga is a powerful lesson in the dangers of ignoring fundamental value in favor of narrative and momentum. It is a perfect illustration of how the psychological urge to act, when combined with social pressure, can lead rational people to make profoundly irrational financial decisions, ultimately destroying their hard-earned capital. The direct financial connection between unchecked action bias and poor investment returns can be quantified with a concept known as the behavior gap. Coined by financial planner Carl Richards, the behavior gap is the difference between the return an investment generates and the return the average investor in that investment actually receives. The gap is the financial cost of bad behavior. For example, let's say a mutual fund that tracks the S&P 500 reports an average annual return of 10% over a 20-year period. You would assume that the investors in that fund also earned 10%. But research from firms like Dalbar and Morningstar consistently shows this is not the case. The average investor in that fund might have only earned 7 or 8%. Where did the missing 2 or 3% per year go? It was lost in the behavior gap. It was destroyed by the investors' own actions. They fell prey to the action bias. When the market crashed in 2008, they panicked and sold at the bottom. When the market felt euphoric in 2021, they got greedy and piled in at the top. They tried to time the market, jumping in and out, always a step behind. They chased performance, selling last year's laggard to buy last year's winner, just in time for their fortunes to reverse. This gap, this 1, 2, or even 3% annual penalty for bad behavior, is the direct, quantifiable cost of succumbing to the psychological traps of action, herd mentality, and overconfidence. Let's put this into concrete numbers. Consider an investor who puts $100,000 into the market. A simple buy-and-hold strategy earns them a 10% annual return. After 30 years, their portfolio is worth approximately $1,745,000. Now consider an investor in the same investments, but whose constant ill-timed action creates a 2% behavior gap. Their net return is only 8%. After 30 years, their portfolio is worth just over $1 million. The behavior gap, the cost of their activity, has cost them nearly $750,000. It is a tax they levied upon themselves. The financial discipline to overcome the action bias is therefore not a minor optimization. It is one of the most significant factors in long-term wealth creation. Every time you resist the urge to sell in a panic, every time you ignore a hot tip, every time you stick to your long-term plan in the face of market volatility, you are actively narrowing your personal behavior gap. You are paying yourself a behavioral dividend that will compound year after year into a fortune. This is the ultimate financial payoff of mastering stock market psychology. It proves that the real battle in investing is not waged against the market. It is waged against the flawed, impulsive, and deeply human instincts within ourselves. If the philosophy of inactivity is the what, and the psychology of action bias is the why, then we need a practical, tangible framework for the how. How does one actually enforce this level of discipline in a world designed to provoke action? Warren Buffett provides the answer with one of his most powerful mental models, the concept of the 20-slot punch card. He advises investors to imagine that they have a punch card with only 20 spaces on it, and each space represents one investment decision for their entire lifetime. Once they have made 20 investments, they cannot make another. This simple thought experiment is a profound tool for enforcing extreme selectivity and transforming one's entire approach to capital allocation. The power of this mental model is perfectly illustrated by Buffett's 1973 investment in the Washington Post. The early 1970s were a turbulent time for the stock market. The Nifty 50 growth stocks had crashed, and the country was mired in stagflation and pessimism. The Washington Post company, despite its iconic brand and its recent journalistic triumphs with the Pentagon Papers and Watergate, was not immune. Its stock price was being hammered, falling by nearly half. The market was treating it like just another company in a sea of red. But Warren Buffett saw something different. He wasn't just looking at a stock ticker. He was analyzing a business. He saw an institution with a near-monopolistic position in a major American city. He saw a brand with immense pricing power with its advertisers. He saw a company led by the brilliant and formidable Katharine Graham. And he saw that due to the market's temporary panic, he could buy this magnificent media franchise for about $80 million, when his conservative valuation told him it was worth at least $400 million. This was what he calls a fat pitch, an obvious, unmissable opportunity. He began to buy shares aggressively, investing nearly $11 million, which was a significant portion of Berkshire's capital at the time. He saw this not as a trade, but as one of his precious 20 punches. He was buying a piece of a phenomenal business with the intention of holding it for a very, very long time. He wasn't just renting the stock, he was becoming a part owner of the Washington Post. That single, highly selective decision, made during a period of maximum market fear, became one of the cornerstones of Berkshire Hathaway's success. That $11 million investment would grow to be worth over $1 billion in the following decades, a return of more than 100 times his initial capital. This is the punch card mentality in action. It's not about making hundreds of good decisions. It's about having the discipline to wait for the rare, once or twice a year opportunity to make a truly great decision, and then to act with conviction. It transforms investing from a game of frantic activity into a patient search for excellence. The 20-slot punch card is not just a charming story. It is a sophisticated psychological hack that leverages several powerful cognitive principles to force better decision-making. The primary principle at play is the scarcity heuristic. Our brains are wired to place a higher value on things that are scarce. When a resource is abundant, we tend to be careless with it. If you have an unlimited number of trades, you are more likely to make frivolous or speculative ones. The thought process is, well, if this one doesn't work out, I'll just try another one. But when you are told you only have 20 decisions for your entire life, each one suddenly becomes immensely valuable. The punch card artificially creates scarcity, which in turn triggers a more rigorous and disciplined thought process. This manufactured scarcity also productively engages our sense of loss aversion. Loss aversion is the well-documented psychological principle that the pain of losing is about twice as powerful as the pleasure of gaining. By framing each investment as the use of an irreplaceable punch, the punch card model makes the potential pain of wasting a punch on a mediocre idea feel far more acute. The fear of losing a precious slot on a speculative bet becomes greater than the fear of missing out on a hot trend. This reorients your entire risk calculus. Instead of chasing small, uncertain gains, your primary motivation becomes the avoidance of a catastrophic, irreversible mistake. It forces you to ask not just, how much can I make, but the more important question, how much can I lose, and what is the probability of that loss? This mental model is also a powerful antidote to choice paralysis. In the modern world, investors are faced with a dizzying array of options, thousands of stocks, bonds, mutual funds, and ETFs. This overabundance of choice can lead to anxiety and poor decision-making, or even an inability to decide at all. The punch card simplifies the world. It tells you that 99.9% of these options are irrelevant noise. Your job is not to analyze everything. Your job is to ignore almost everything. You are a hunter waiting for a specific type of prize animal, not a fisherman dragging a giant net across the ocean floor. This intense focus conserves your most valuable resource, your attention. It's a masterclass in financial discipline, using the built-in quirks of our own psychology to our advantage, turning our aversion to loss and our attraction to scarcity into powerful engines of rational and selective investing. To bring this powerful mental model out of the realm of theory and into your own financial life, you can undertake the punch card portfolio exercise. This is a tangible, step-by-step process for implementing this philosophy. The first step is to create your physical punch card. Take a simple index card. With a pen, draw 20 circles on it. Label it My Lifetime Investment Punch Card. This act of creating a physical artifact is more powerful than you might think. It makes the abstract concept of scarcity real and visible. Place this card on your desk or somewhere you will see it regularly. It will serve as a constant reminder of the high bar your decisions must clear. The second step is to define your great idea threshold. On the back of the card or in a separate document, you must write down in specific and measurable terms what constitutes a punch-worthy investment for you. This is an extension of your investment policy statement. What specific financial metrics must be met? A price-to-earnings ratio below 15? A debt-to-equity ratio below 1? A history of at least 10 consecutive years of dividend growth? What qualitative factors are essential? A durable competitive moat? A management team with a long track record of integrity and skill? A business model you can fully understand? This document is your filter. An idea must pass every single one of these tests before it can even be considered for a punch. The third step is to ritualize the process of punching the card. When you find an investment that meets your stringent criteria and you decide to act, you must physically take a pen and cross off one of the circles. On the back of the card, write the date and a one-sentence summary of your investment thesis. This should feel like a solemn, significant act, because it is. You are deploying a precious, non-renewable resource, one of your lifetime investment decisions. The final step is to create a no-punch zone to safely manage your speculative impulses. It is human nature to be tempted by a gamble. To quarantine this instinct, you can create a separate, much smaller portfolio that you label your casino account. You allocate a tiny fixed amount of capital to it, an amount that you would be perfectly comfortable losing entirely, say 1 or 2% of your total investable assets. This is where you can play with hot tips, speculative stocks, or anything that does not meet your rigorous punch card criteria. This quarantines the gambling from the serious business of wealth building, allowing you to scratch the itch for action without ever threatening your long-term financial security. This structured exercise transforms the punch card from a clever idea into a robust operational framework, building the habits of patience, selectivity, and discipline that are the hallmarks of an intelligent investor. The antithesis to the focused, potent punch card approach is the far more common strategy of what we can call unwitting diversification. This is the path taken by the investor who believes that owning more stocks automatically means they are safer. Their portfolio often contains 50, 70, or even over 100 different individual stocks alongside a dozen different mutual funds that likely have significant overlapping holdings. They believe they are practicing prudent diversification, but in reality, they are practicing what Warren Buffett calls diversification. They have made so many decisions that they have no deep understanding of any of them. They cannot tell you why they own the 47th stock in their portfolio or what its competitive advantages are. They have confused activity with diligence and breadth with safety. This is what Buffett refers to as a Noah's Ark style of investing. They buy two of everything. The result of this approach is guaranteed mediocrity. Their best ideas, the one or two truly great businesses they may have stumbled upon, have their performance drowned out by the sea of their mediocre and bad ideas. A brilliant investment that makes up only 1% of a portfolio cannot have a meaningful impact on that person's net worth, even if it doubles or triples in value. This investor hasn't made 50 great decisions. They have made one bad decision 50 times over. The decision to not be selective, to not have conviction, and to substitute thoughtless accumulation for rigorous analysis. They have built not a portfolio, but a museum of their past hunches and hot tips. Their financial statement is a testament to a lack of discipline. The punch card investor, by contrast, understands that true safety comes not from owning many things, but from deeply understanding the few things you do own. Their concentrated portfolio of 10 to 15 of their absolute best ideas, each one thoroughly researched and purchased with a significant margin of safety, is in fact far less risky than the 100-stock portfolio of the amateur collector. The punch card investor has put their money where their mind is. They have done the hard work of saying no 1,000 times so that they could say a truly meaningful yes just a few times. The path of the 99% is a path of collecting. The path of the intelligent investor is a path of curating. The direct financial connection of the punch card mentality is the profound mathematical advantage of concentrated high-conviction investing. It is the mechanism by which your best ideas can have a life-changing impact on your net worth. Let's quantify this. Imagine two investors, Diana the diversifier and Conrad the concentrator. Both have a $100,000 portfolio. Diana, following the path of the 99%, builds a portfolio of 100 stocks, each representing 1% of her capital. Conrad, following the punch card philosophy, builds a portfolio of just 10 stocks, each representing 10% of his capital. Now, let's say both investors have one truly brilliant idea. They both identify a wonderful company, let's call it Quality Company, early in its growth story. Over the next decade, Quality Company's stock increases tenfold. For Diana, this is a pleasant event. Her $1,000 investment in Quality Company is now worth $10,000. Her total portfolio has grown from $100,000 to $109,000, a 9% gain from her best idea. She feels good about it, but it hasn't fundamentally changed her financial situation. For Conrad, the outcome is transformational. His $10,000 investment in Quality Company is now worth $100,000. His total portfolio has grown from $100,000 to $190,000, a 90% gain from his single best idea. His financial life has been permanently altered by his conviction. He did not dilute his brilliance. The mathematics are undeniable. Concentration, when backed by rigorous research and a long-term holding period, financially amplifies the rewards of being right. The punch card method forces you to save your capital and your intellectual energy for these rare, high-probability, high-return opportunities. It prevents you from squandering your resources on low-conviction, low-impact ideas. It is the ultimate expression of the value investing ethos. Be fearful when others are greedy, be greedy when others are fearful, and for the vast majority of the time in between, have the discipline to do absolutely nothing, waiting for the one fat pitch that can make a career. This is how immense wealth is built, not through 1,000 small, timid bets, but through a handful of large, bold, and deeply intelligent ones. The average market participant operates with what can only be described as a casino mentality. They are fixated on the flashing lights and spinning numbers of the stock ticker. Their emotional state is tied to the daily, hourly, and even minute-by-minute fluctuations of the market. They see investing as a game of predicting short-term price movements, a contest of outsmarting the collective mood of the crowd. This frantic confusion of motion with progress is the fourth and perhaps most pervasive barrier to long-term wealth. To build a truly unshakable investment philosophy, one must consciously reject this casino mindset and adopt the calm, rational, and detached perspective of a private business owner. The ultimate masterclass in this mindset shift was Warren Buffett's conduct during the absolute nadir of the 2008 financial crisis. In the fall of that year, the global financial system was on the brink of collapse. Lehman Brothers had failed, panic was rampant, and credit markets were frozen. Fear was palpable. The prevailing emotion was sheer terror, and the dominant action was indiscriminate selling. People were dumping everything, good assets, bad assets, in a desperate flight to the safety of cash. This was the casino in meltdown mode. In the midst of this chaos, Warren Buffett was a pillar of calm. His inactivity in the preceding years, his refusal to participate in the subprime mortgage bubble, had left him with a fortress of cash within Berkshire Hathaway. And while the world was panicking, he began to selectively act. But he wasn't trading. He wasn't trying to time the bottom. He was behaving like a lender of last resort, a financial fireman providing capital to fundamentally sound institutions that were temporarily paralyzed by fear. In September 2008, he invested $5 billion in Goldman Sachs. He didn't just buy their common stock. He negotiated a brilliant deal, receiving preferred stock that paid him a 10% annual dividend, $500 million a year, and he received warrants that gave him the right to buy more shares at a fixed price in the future. A few weeks later, he did a similar deal with General Electric. The following year, with Bank of America on the ropes, he invested another $5 billion under similarly favorable terms. He was not gambling on stock prices. He was making strategic long-term investments in the core infrastructure of the American economy at a time when he could name his price. His actions were a direct result of his mindset. A casino gambler would have been frozen in fear or would have been trying to make small, speculative bets on the bounces. Buffett, the business owner, saw great American franchises on sale at bargain prices and had the courage and the capital, preserved through years of prior inactivity, to act decisively. He was not reacting to the market's mood. He was responding to an unprecedented business opportunity. His famous op-ed in the New York Times titled "Buy American, I Am" was not a market timing call. It was a business owner's declaration of faith in the long-term earning power of the country. This episode perfectly encapsulates the chasm between the trader and the owner. The trader asks, "What will the price be tomorrow?" The owner asks, "What is the long-term cash-generating power of this enterprise?" One leads to frantic, emotional decisions, the other to calm, rational, and extraordinarily profitable ones. The casino mentality is driven by a set of powerful psychological biases that warp our perception of risk and reward. The first of these is salience bias, our tendency to focus on information that is dramatic, emotionally charged, and easily recalled. A stock market crash is salient. The screaming headlines, the plunging red arrows on the screen, these things capture our attention and hijack our decision-making. The slow, boring year-over-year increase in a company's earnings is not salient. It gets lost in the noise. The casino-minded investor is therefore always reacting to the most recent, most dramatic event, ignoring the underlying long-term fundamentals. This is closely related to recency bias, which is our tendency to give greater importance to recent events than to distant ones. If the market has been going up for the past 2 years, we start to believe it will go up forever. If it has been falling for 6 months, we extrapolate that trend and believe a depression is imminent. We allow the recent past to dictate our entire view of the future, forgetting the long history of market cycles and the inevitability of recovery. But perhaps the most profound psychological distinction is the concept of an external versus an internal locus of control. An individual with an external locus of control believes that their life is controlled by outside forces, by luck, fate, or powerful others. The trader with a casino mentality has an external locus of control. Their happiness, their fear, their decisions are all dictated by the market's daily whims. The ticker tape is their master. An individual with an internal locus of control, by contrast, believes that they are in control of their own destiny through their own efforts and decisions. The business owner, the intelligent investor, has an internal locus of control. Their decisions are based on their own independent analysis of a company's intrinsic value. They see Mr. Market as a manic-depressive business partner who sometimes offers to sell them shares at absurdly low prices and at other times offers to buy them at ridiculously high prices. They are free to ignore his mood swings and act only when his offers serve their own long-term interests. Cultivating this internal locus of control is the psychological foundation of becoming a true investor. It is the mental shift that allows you to see market volatility not as a threat, but as an opportunity. It is the source of the emotional fortitude required to buy when everyone else is selling and to patiently hold when everyone else is chasing speculative fads. To systematically dismantle the casino mentality and rebuild your perspective into that of a calm business owner, you need a practical toolkit. This is the Business Owner's Audit, a set of 4 exercises designed to reframe your relationship with your investments. The first exercise is a powerful thought experiment. Pick one stock that you own. Now, imagine you receive an official, irrevocable notice that the stock market will close tomorrow and will not reopen for 10 years. You will be unable to sell your shares for a full decade. Ask yourself, how does that make you feel about owning this particular company? Are you filled with a sense of calm confidence, happy to be a part owner of this enterprise for the long haul? Or are you filled with a sense of dread, realizing you bought it for its short-term price momentum? If you are not thrilled to own a business under these conditions, you must ask yourself why you own it at all. This 10-year test instantly clarifies whether you are thinking like an owner or a speculator. The second exercise is to write a pre-mortem. When you are considering a new investment, before you buy, you must perform this exercise. Imagine it is 5 years in the future, and this investment has been a complete and utter disaster. Your thesis was wrong, and you have lost a significant amount of money. Now write a detailed, 1-page story explaining exactly how and why it failed. Was it disrupted by a new technology? Did its competitive advantage prove to be weaker than you thought? Did a new management team make a series of poor capital allocation decisions? This process forces you to confront the real business risks from the very beginning, moving your focus away from the alluring upside and onto the potential for permanent capital loss. The third tool is to learn how to calculate owner earnings. Go beyond the simple, often misleading metrics like the P/E ratio. Dig into a company's financial statements and learn to calculate the metric Warren Buffett considers the true measure of a business's value: owner earnings. This is roughly defined as net income, plus depreciation and amortization, minus the average annual amount of capital expenditures needed to maintain the business's competitive position. Learning to perform this calculation shifts your focus entirely. You stop caring about what the stock market thinks the company is worth on any given day and start focusing on the actual cash the business can generate for its owners over time. The fourth and final exercise is to ignore the ticker. For one full week, pick one of your holdings and commit to tracking only the company's operational news. Read its press releases, follow news about its products, study its competitors, moves, and analyze trends in its industry. But you must absolutely forbid yourself from looking at its stock price. This exercise trains you to separate the business from its stock. You begin to appreciate the day-to-day reality of the enterprise, which moves far more slowly and logically than its often erratic stock price. Together, these four exercises, the 10-year test, the pre-mortem, the owner earnings calculation, and ignoring the ticker, are a powerful regimen for reprogramming your mind, curing you of the casino mentality, and instilling the patient, long-term perspective of a true business owner. The opposite of the patient business owner is the hyperactive day trader, the living embodiment of the casino mentality. The day trader's world is not one of balance sheets and competitive moats. It is a world of one-minute charts, technical indicators, and adrenaline. Their vocabulary is filled with terms like breakouts, resistance levels, and stochastic oscillators, not return on invested capital or durable competitive advantage. They are the epitome of someone who confuses motion with progress. The day trader's entire strategy is based on the flawed premise that they can consistently predict the short-term, emotionally driven fluctuations of the market. They are engaged in a zero-sum game, not just against other traders, but against sophisticated institutional algorithms that can execute trades in microseconds. The long-term success rate for this endeavor is abysmal. Study after study has shown that the vast majority of day traders lose money. They are destroyed by the very activity they believe is their edge. They pay the highest possible transaction costs, as broker commissions and bid-ask spreads eat away at their capital with every trade. They suffer the most punishing tax consequences, as any gains are taxed at the highest short-term rates. And they endure the most psychological stress, chained to their screens, riding a roller coaster of greed and fear. They have mistaken the random noise of the market for a discernible signal. They are like a surfer trying to predict the exact shape and motion of every single wave in a stormy sea, an impossible and exhausting task. The business owner, by contrast, is like the lighthouse keeper. They are not concerned with the motion of each individual wave. They have built their lighthouse on a solid foundation of bedrock, their deep understanding of the business's intrinsic value. Their job is to ensure the light, the company's long-term earning power, continues to shine, providing a steady beacon regardless of the temporary fury of the storm. The day trader's path is one of constant motion, high costs, high taxes, and high stress, leading almost inevitably to financial ruin. The business owner's path is one of selective action, low costs, low taxes, and peace of mind, leading to the steady, powerful accumulation of wealth. The most direct and brutal financial consequence of adopting a casino mentality is the tax bill. The tax code is, in effect, a massive penalty for hyperactivity and a huge reward for patience. This creates a powerful form of tax arbitrage for the long-term investor. When an investor buys and sells a stock within 1 year, any profit they make is classified as a short-term capital gain. This gain is taxed at the same rate as their ordinary income, which for high earners in the United States can be as high as 37% plus state taxes. When an investor buys a stock and holds it for longer than 1 year before selling, the profit is classified as a long-term capital gain. The tax rate on these gains is significantly lower, 0%, 15%, or 20%, depending on the investor's overall income level. For most people, the long-term rate is more than $500,000 for both. Let's run the numbers to see the staggering impact of this difference. Imagine two investors, trader Tom and owner Olivia. Both make a successful investment, realizing a $50,000 profit. Tom, the day trader, held the stock for 3 months. His $50,000 gain is taxed at his ordinary income rate of, let's say, 32%. He immediately owes the government $16,000 in taxes, leaving him with a net profit of $34,000. Olivia, the business owner, held the same stock for 3 years. Her $50,000 gain is taxed at the long-term capital gains rate of 15%. She owes the government just $7,500, leaving her with a net profit of $42,500. By simply doing nothing for an additional 2 years and 9 months, Olivia's profit is $8,500, or 25% larger than Tom's. The government has become the day trader's silent partner, siphoning off a huge portion of their winnings. For the patient, long-term investor, the government's role is far more benign. This tax differential is a direct and massive financial incentive for inactivity. Every day you hold a winning investment beyond the 1-year mark, you are effectively increasing your after-tax return. Patience is not just a virtue, it is a tax-advantaged financial strategy. This proves, in the unambiguous language of the IRS tax code, that the system is explicitly designed to reward the calm business owner and penalize the frantic casino gambler. There is an unseen force in the universe of finance, a power so immense that Albert Einstein is said to have called it the eighth wonder of the world. It is the engine of all great fortunes, the silent partner in every successful long-term investment strategy. This force is compounding, and the single most important ingredient it requires is time. The philosophy of disciplined inactivity is, at its core, a strategy designed to unleash the full, uninterrupted power of this force. It is the final and most crucial pillar of the intelligent investor's mindset, the understanding that the greatest returns are generated not by brilliant trading, but by letting a wonderful business grow and reinvest its earnings, year after year, decade after decade, undisturbed. The greatest foundational anecdote for this principle is not a single investment, but the entire history of Berkshire Hathaway itself. The story does not begin with a stroke of genius, but with a mistake. In the mid-1960s, Buffett bought control of a struggling New England textile mill. He soon realized that the business was doomed, a relic of a dying industry. The casino-minded trader would have sold it, perhaps for a small loss, and moved on to the next idea. But Buffett, the emerging business owner, did something different. He didn't try to be a hero and save the textile operations. Instead, he began to use the small, dwindling streams of cash that the failing business generated and allocated that capital into far better businesses. He bought insurance companies like National Indemnity. He bought See's Candies. He bought the Washington Post. And then, the most important part of the strategy kicked in. He waited. He let the earnings from these great businesses accumulate within the corporate structure of Berkshire Hathaway. Instead of paying them out as dividends, he reinvested them into more great businesses. This created a flywheel. The earnings from See's Candies helped buy a piece of Coca-Cola. The insurance float from National Indemnity helped buy the BNSF Railway. Each successful investment generated more cash, which was then redeployed to buy more cash-generating assets. The growth of Berkshire Hathaway's book value per share tells the story. For the first few years, it was slow and linear. But as the capital base grew, the power of compounding began to take hold. The curve started to bend upwards, slowly at first, then dramatically. It became an exponential explosion of value. The story of Berkshire Hathaway is not the story of 1,000 brilliant trades. It is the story of a few dozen brilliant capital allocation decisions, followed by 50 years of patient, disciplined inactivity, which allowed the snowball of capital to roll down a very, very long hill, gathering mass and momentum with each passing year. The inactivity was the active ingredient. It was the refusal to interrupt the compounding process that allowed it to work its incredible magic. The human brain is notoriously bad at understanding the power of compounding because we are wired to think in linear, not exponential, terms. The psychological hurdle we must overcome to truly embrace a long-term, buy-and-hold strategy is a cognitive bias known as hyperbolic discounting. This is our innate tendency to prefer smaller, immediate rewards over larger, later ones. Given the choice between $100 today or $110 in a month, most people will take the $100 today even though the latter represents a staggering annualized return. Our brain's reward system is wired for the now. Compounding is the ultimate delayed reward. It offers a relatively small benefit today in exchange for a colossal benefit in the distant future. To become a successful long-term investor, you must psychologically override this flawed intuition. One way to do this is to force your brain to visualize the physics of exponential growth. If I were to offer you a choice between $3 million in cash today or a single magic penny that doubles in value every day for 31 days, most people's intuition would scream to take the cash. A single penny seems insignificant. Let's run the math. After 1 week, day 7, the penny is worth 64 cents. You feel foolish. After 2 weeks, day 14, it's worth $81.92. Still not impressive. After 3 weeks, day 21, it has grown to over $10,000. Interesting, but still far from $3 million. But then, the exponential magic takes hold. On day 28, the penny is worth over $1.3 million. On day 29, it's $2.7 million. On day 30, it's $5.3 million. And on the final day, day 31, that single penny has compounded into $10,737,418. This is the power you unleash when you refuse to interrupt the process. Every time an investor sells a great company after it has merely doubled or tripled, they are effectively choosing the $3 million in cash and walking away from the magic penny on day 25, forgoing the massive exponential gains that come in the final and most critical stages of the journey. To master patient investing, you must burn this visualization into your mind. You must develop an intuitive, gut-level appreciation for the explosive power of the upward curving line. This is the psychological hack that builds the conviction necessary to hold on through market downturns and to resist the temptation of taking a small, quick profit, allowing your investments the one thing they need to reach their full potential, an uninterrupted runway of time. To harness this incredible force, you need to build a system, a compounding machine that works for you automatically in the background of your life. This blueprint is about designing your financial habits to make patient, disciplined investing your default setting. The first and most crucial component of this machine is to automate your investments. Set up an automatic transfer from your checking account to your investment account that occurs every month or with every paycheck, without you having to think about it. This simple act of paying yourself first is incredibly powerful. It makes patient investing your default behavior. It removes emotion and timing from the equation. Whether the market is up or down, you are systematically accumulating assets. This is a form of forced, disciplined activity that perfectly enables long-term, beneficial inactivity. The second component is to turn on DRIP, or the Dividend Reinvestment Plan, for all of your investments. When a company you own pays a dividend, instead of taking it as cash, the DRIP automatically uses that money to buy more shares or even fractional shares of the same company. This is compounding in its purest and most elegant form. It creates a virtuous cycle. Your shares pay dividends, those dividends buy more shares, which in turn generate even more dividends in the next cycle. You are doing absolutely nothing, yet your ownership stake in your best companies is growing with every passing quarter. The third step is to give yourself a concrete long-term target by calculating your financial freedom number. This is the amount of capital you need to accumulate, such that you can live off a safe percentage of its returns, typically 3 to 4%, indefinitely. Once you have this number, use a compounding calculator to chart your path. See how your automated monthly investments, combined with a reasonable expected rate of return, will get you to that number, and on what date. This makes the long, abstract journey tangible and motivating. It turns the fuzzy idea of retirement into a specific target, reinforcing the discipline needed to stay the course. The final component is a mindset shift. You must adopt a generational perspective. Begin to think of your portfolio not as a piggy bank for your own short-term wants, but as a legacy asset, a financial engine that you are building for your children and your children's children. This radical extension of your time horizon makes the noise of short-term market volatility seem utterly insignificant. A 10% drop in the market is a terrifying event if your time horizon is next year. It is a minor blip, a historical footnote if your time horizon is the next 50 years. By building this automated machine and adopting this long-term mindset, you align your actions and your psychology with the unstoppable force of compounding. The antithesis of the compounding mindset is the lottery ticket mentality. This is the investor who is perpetually searching for the 10-bagger that will make them rich overnight. They are not interested in the slow, steady, almost boring process of compounding. They crave the thrill of the chase, the jackpot, the quick score. This investor jumps from one speculative idea to another. They might buy a penny stock on a hot tip, ride it up 30%, then sell, and immediately start looking for the next one. They might pour money into a highly speculative cryptocurrency hoping it will be the next Bitcoin. With each sale, whether for a small gain or a loss, they are resetting their compounding clock back to zero. They never give a quality investment the one essential ingredient it requires to create true wealth: time. They are like a gardener who is constantly planting seeds, and then, a week later, digging them up to see if they are growing. This constant disruption ensures they will never harvest a mighty oak tree. They may get lucky once or twice, hitting a small jackpot that temporarily validates their strategy. But they tragically mistake luck for skill. Because they have no repeatable process, no underlying philosophy other than get rich quick, they inevitably give those winnings back to the market on their next dozen lottery ticket bets. They are trapped on a financial hamster wheel, a cycle of constant motion, high hopes, and ultimate disappointment. They do not understand that the real money in investing is not made in the buying or the selling, but in the waiting. The intelligent investor, the owner of the compounding machine, understands that wealth is not an event. It is a process. It is the patient accumulation of ownership in great businesses, allowing the miracle of compound growth to do the heavy lifting over a lifetime. The lottery ticket chaser is playing a losing game against the house. The patient compounder has made the house their partner. The final, direct financial connection that ties this all together can be illustrated with a simple but profound mental model: the Rule of 72. This rule is a quick, back-of-the-envelope way to understand how long it will take for your money to double at a given rate of return. You simply divide the number 72 by your annual interest rate. For example, at a 10% annual rate of return, your money will double approximately every 7.2 years. Let's see how this rule demonstrates the catastrophic cost of interrupting the compounding process. Consider a 30-year-old investor who has accumulated a $100,000 portfolio. If they can achieve a 10% annual return and they do absolutely nothing, their financial future is almost set. At age 37, their portfolio is worth $200,000. At age 44, it's $400,000. At age 51, it's $800,000. At age 58, it's $1.6 million. And by the time they retire at age 65, that initial $100,000 has become over $3.2 million, all through the power of patient, uninterrupted compounding. Now, let's introduce one single, emotionally driven mistake. In the fourth year of their journey, the market has a scary downturn, just like in 2008 or 2020. Our investor panics. They succumb to the action bias and sell everything, moving to cash. They sit on the sidelines for 3 years, waiting for things to feel safe again, before reinvesting. They have missed one of the doubling periods. That single decision, that 3-year interruption, has a devastating impact on their final outcome. Because they missed one doubling, their final nest egg at age 65 is not $3.2 million. It is $1.6 million. That one moment of panic, that one failure of discipline cost them $1.6 million. It wasn't the market that stole their future. It was their own behavior. The Rule of 72 proves with stark clarity that time is the most critical variable in the wealth equation. The cost of being out of the market, even for short periods, is not linear. It is exponential. It is the millions of dollars on the back end of your life that never get a chance to materialize. This is the ultimate financial case for disciplined inactivity. It is the final promise of this philosophy. If you can learn to control your impulses, to ignore the noise, and to give your investments the gift of uninterrupted time, you will unleash the most powerful force in the financial universe to work on your behalf, building a future of security, independence, and true financial freedom. You have just spent this time rewiring the very foundation of your financial mind. You have absorbed a system of thought that runs contrary to everything our culture screams about money, speed, and action. You have been given the blueprint to build a fortress of inactivity, a mental stronghold that will protect your capital not from market forces, but from your own worst instincts. This is not just investment advice. It is a powerful tool for clear thinking, an operating system for rational decision-making in an irrational world. You now possess the understanding to turn patience from a passive virtue into an active, offensive weapon. But the journey to mastering this wealth mindset is not complete. The philosophy of an intelligent investor like Buffett is not a single pillar. It is an interconnected cathedral of mental models. What you have just mastered is the foundational principle of when not to act. It is the art of strategic defense. But for this system to be whole, it must be connected to its counterpart, the equally disciplined and rigorous framework for knowing when it is, finally, time to strike. The video that is now appearing on your screen is not a random suggestion, it is the next piece of the map. It is the link that connects the fortress of inactivity to the arsenal of decisive action. It illuminates the specific criteria, the non-negotiable metrics, and the deep financial analysis required to identify one of those rare 20-punch card opportunities. To click away now would be like learning how to build an impenetrable shield without ever learning how to wield a sword. The choice you have is not simply about what to watch next. It is a choice about who you want to become. Are you a tourist in the world of financial knowledge, collecting random facts? Or are you an architect, committed to building a complete and unshakable mental framework for a lifetime of success? If you are ready to continue your ascent, to connect the piece you have just mastered with the next critical link in the chain, the path is right in front of you. Complete your arsenal,